Government price floor and project vault, immediate silver market shift. Disclaimer: this is time sensitive. Recent official transcripts and filings describe new, enforceable measures that materially change silver market structure. A government-backed strategic stockpile, Project Vault, with roughly $12 billion in capital and substantial export/tariff enforcement authority has been launched, plus export licensing changes by a major refining nation. Together, these actions create a de facto buyer of last resort and an automatic price floor mechanism enforced via tariffs. The core mechanics: shorts relied on the ability to push paper prices lower to cover positions. That model depends on abundant, freely tradable physical inventories. Current data show a severe mismatch. Global exchange and vault inventories are at multi-year lows while the paper-to-physical ratio remains extremely high, hundreds of paper claims per physical ounce. When a state-backed price floor is enforced and large buyers lock up multi-year supply through a government program, shorts lose their exit strategy and are forced to bid for scarce physical metal, triggering cascades and margin calls. Inventory and supply signals: U.S. exchange-registered silver inventories have fallen sharply, as have major London and Shanghai inventories. A recent export licensing regime by a major refinery center has dramatically reduced refined exports month over month, creating a choke point that removes significant refined supply from global markets. Simultaneously, industrial demand, solar, EVs, 5G, defense, electronics, has risen substantially, consuming a large share of annual mine production. Regulatory drivers: new designation of silver as a critical mineral activated trade remedy authority that permits tariffs for national security reasons. Combined with Project Vault procurement and tariff enforcement, this creates a structural, legally underpinned price floor, implemented without a direct treasury outlay, while preferential trade arrangements concentrate a large share of production inside the bloc. Immediate market consequences: if physical delivery demand outstrips available inventories, clearing banks and exchanges may invoke force majeure clauses or cash settle contracts at prior reference prices, leaving buyers short of metal and exposed to a rising physical premium. That cash settlement mechanism can crystallize losses for holders of paper claims while physical premiums spike. The resulting arbitrage and margin stress can propagate through futures markets, producing extreme short squeezes and systemic price dislocations. Practical actions for holders of unallocated or paper positions. Contact your custodian now and request conversion to allocated, segregated storage or physical withdrawal. Document any refusals, delays, or written excuses from dealers or vaults. Verify dealer premiums and lead times, record and report discrepancies. Reassess exposure size relative to physical availability and risk tolerance. Longer-term implications: with concentrated short positions held by a few institutions and major producers operating under preferential arrangements, the freely tradable pool of supply may shrink substantially. Price discovery could shift toward a new equilibrium driven by physical scarcity and government policy, with historical gold-silver ratio reversion scenarios implying materially higher silver prices under sustained government stockpiling and restricted exports. This is an operational market structural change, not a routine policy note. If the filings and export controls are accurate and procurement continues, expect accelerated inventory draws, rising physical premiums, and episodes of forced cash settlement or delivery failures. Act promptly if physical possession or allocated storage is important to you.